Keurig Dr. Pepper, ticker symbol KDP, has seen a massive amount of insider buying over the last 10 days. We can see insider buying of up to $20 million, which is an extremely bullish signal. We're going to take a look at this company in today's episode to see whether or not this is a huge undervalued company that we should at a minimum be putting onto our watch list. As always, we'll look at the historical performance of KDP. We'll take a deep dive into their numbers, a top line and their bottom line review, seeing if it is increasing year on year. We'll have a quick look at the health of this company, cash versus total debt, and we'll see how they're performing versus some of the others in the industry and their competitors. We'll look to the institution to see if they are continuing to buy this company, which has been hammered over the last few months. And we'll also just talk about this insider buying that we have noted from a few members of the key inside management team. And we'll also take a look at the dividend safety. We'll look at the financial metrics and see what we believe for the growth over the next 5 to 10 years. And as always, we'll run them through the valuation model, getting to the intrinsic value as well as our acceptable buy price, given the investor margin of safety, and look at Wall Street's forecast for the next 12 months. So taking a look at this company, we can see over the last 12 months, they are down around 15%. They are pretty much heading towards their 52-week lows with a yield of just under 3% and a forward PE sitting around 15.35. Now, over the last 10 years, if you have been holding this company, you would be up around 244%. Again, important to bear in mind, these numbers don't include those dividends reinvested, and we can see they have touched their all-time highs of $40 a few times over the last few years. Now, in terms of their numbers, what we want to see for a company like KDP, around 3 to 7% growth year on year, $11.1 billion on their top line in 2019. In their more recent numbers, we see revenue of $14.8 billion, so nice to know it has increased over the longer term. When we take a look in terms of a granular level, it's also nice to report that every single year they have increased their top line, so year-on-year numbers are looking very good, and we'll look at them percentage-wise going back as far as 10 years. In terms of the bottom line net income, $1.2 billion in 2019 reported as net income, 2023 $2.2 billion, so they have increased their bottom line over the last 5 years. When we take a look on a more granular level, we do see an increase to 2021 before quite a steep drop down in 2022, so it is positive to note it did rebound back in 2023. Now, in terms of their balance sheet, a quick health check, what we can see, total cash versus total debt, it has increased quite significantly from $76 million in 2019 to $267 million. Now, when we compare that to their total debt numerically and directionally, what we can see is it has reduced, although very minimally, from $15.2 billion to $15.1. So cash has increased a fair amount, although their total debt does remain fairly stable. And we'll take a look at the metrics to see whether or not this is a red flag indicator. Now, in terms of comparing them to other companies in the industry, we have the consumer staples, we have Coca-Cola, Euro-Pacific, Celsius Holdings, and we have a few others including Monster Beverage. Now, what we do know is that over the last 12 months, so including those dividends reinvested, they are down 13%, the worst performing in these competitors that we have selected. Over the last 5 years, though, we do note they are up 19%. Again, one of the worst performing we can see. In fact, Celsius up an incredible 7,200. But in comparing it to the other ones, we do see they are still lagging. So over the last year and the last 5 years, the worst performing. But again, remember that past performance is not an indicator of future performance. Institutional ownership, 52%. We see in terms of sales, $3.5 billion over the last 12 months. We see more buying by these institutions over the same time period, and we also know every single quarter, including the more recent quarter, institutions have been buying a lot of these shares, so they do look very bullish on this company moving forwards. As we mentioned at the beginning of the episode, we can see insiders. We have the CEO and executive chairman. We have a couple of directors, the CFO as well as the chief R&D officer, all buying a ton of shares. In fact, we see the CEO buying around $5 million worth and the CFO buying another 2.5. What's also important to note, though, since they have bought, the shares haven't moved too much, so they have pretty much bought over the last week. And remember, we do see this as a very bullish signal, as insiders do buy for one reason: they do believe the share price will go up. So something just to consider. In terms of the dividend safety, we have a score of 70. It does look to be safe. Market cap 41 billion. This is a large cap company. In terms of the recessionary metrics, well, no dividend was paid, so no comparative data. But they had plus 44% sales, which is well above the average growth of the S&P, which had negative 12%. Also, a very nice dividend increase in the more recent period, 7.5% in September 2023, double digits over the last 5 years on average at 23%. Now, we do note they have increased those dividends for the last 3 years. As we can see from the graph above, they did have that dividend cut in 2015, and there was no dividend paid in 2016 and 2017. Since then, though, they have been increasing those dividends for the last 3 years, with paying a dividend for the last 5 without a reduction. Now, in terms of dividend yield theory, we have two very, very severe signs of undervaluation. 2.94 yield versus the 5-year average of 2.13. Forward PE 15.3, well below the 5-year average of 20.8. And we can see it is significantly lower than the consumer staples sector PE of 20.3. But always remember, we never look at any models themselves in pure isolation and conclude towards the end. Now, the free cash flow payout, I say a blanket rule of 60%. If you want to be consumer staples specific, you can bring that up to 70%. 2022 and over the last few years before that, pretty low. 2023, what we would call a red flag indicator. The reason for this signals the management in 2023 paid out a lot more in dividends than they generated in free cash flow. Something that you can't see by looking at the earnings, which is why we typically don't look at earnings data. It is susceptible to manipulation by management through their accounting. On a more positive note, 2024, they are expecting to bring this down to 60%. So at least that does give us some faith that there should be no issues with those dividends. Free cash flow per share, a little bit of a poor sign. The fact it has been decreasing over the last 10 years. Not something you want to see. At a bare minimum, you want it to be stable, ideally increasing. 2024, though, it is expected to increase quite severely from that 2023 61 cents to $1.43. In terms of sales growth, well, actually pretty decent when we consider steady moderate growth is the aim of 3 to 7% for a company in this industry size as well. Over the last year, we see an increase of 5%, before that double-digit growth, so looking pretty strong. And numerically speaking, we can see it has gone from $4.5 billion in 2015 to just under 15. Now, shares outstanding, we love it when companies essentially return excess cash through share buybacks, increasing your stake in a company. What we see is they've done the opposite, so they would have diluted your position over the last 10 years, going from 159 million in 2015 to 1.41 billion. So something just to consider. ROIC, this is one of my favorite metrics. I want to see at least 10% or more, just to give me faith that management are able to effectively allocate their capital. And over the last 10 years, they've only managed that in the first year of the data we have of 2015. Since then, around 6 to 7%, so something just to consider and maybe factor in when you are looking at that margin of safety level. Operating margin, no real worries to note, considering above 16% is our specific look. 17% in 2015, 22% in 2023. Over the longer term, they are increasing that operational efficiency. Nice to note there. Free cash flow margin, pretty solid over the last 10 years, although we do note 2023, it did drop significantly from that 18% level, below that 7% target that we have. Not a massive red flag indicator, but something you can just keep an eye on over the next few years. Net debt to EBITDA, then the earnings before interest, tax, depreciation, amortization. What we're looking for here is below 4 for consumer staples. Essentially the number of years it would take the company to pay off all of their debt net of cash on hand. Remember, below 4, it has been below 4 over the last 4 years, so looking pretty solid. 3.34 in 2023. Also nice to note, in 2024 it is expected to go a little bit lower to 3.16. So no real worries, but again, something you can just monitor, given over the last 10 years, there have been a number of years, as we can see here, where it has gone above that. But based on the data so far, it isn't looking that bad. No real red flag indicators to note just yet. But one thing we would say is be wary of that free cash flow payout to ensure it doesn't go above that 100% level again. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model. We have Graham's valuation, we have the earnings per share 155, the long-term growth rate per analyst estimates, and that AAA corporate bond yield. We get an intrinsic value of $22. Now this is significantly below the market value, so we have a sign now of overvaluation. Just bear in mind though, we're not looking at any of these in isolation. We then have the multiples valuation model, those companies we looked in a similar size and sector. We have the average P multiplied by the EPS to get an intrinsic value of some strong undervaluation, and here we have that undervaluation signal with the intrinsic value of $48. In terms of looking at the dividend discount model, we have the increases to the dividend. We see some years where they in fact kept it flat. Over the last 3 years though, some strong growth, and on average at 7.8%. We've gone for a little bit more conservative at 5.5%, which is in fact lower than what they did offer over the last 3 years. This gives an intrinsic value showing some nice signs of undervaluation again. So far we have 2 signs of undervaluation and 1 of overvaluation. We then have the DCF model with the free cash flow year on year. We have an average growth rate of 15% and forward-looking 8%. We have used 8%, which we do believe to be fairly essentially conservative, given the fact that it's lower than the average growth, as well as lower than analysts' targets. Now what we've done here, as we can see, there was a large drop in 2022 to 2023, so the expectation for 2024 we have put as the previous year, and we can see over the last 4 years it has been pretty much around that level. So with that, the growth rate and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have another sign of undervaluation. So in today's episode, we have those 4 models, 3 which showed undervaluation, 1 which showed overvaluation. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, or those on your watch list by clicking on that pinned comment. So margin of safety, as always, we want to start off with 10%, and we use that if it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, then the acceptable buy price would be around $32.59. At 15%, around $30.77. And at 20%, it isn't quite there yet at around $29, although not too far off. So in today's episode of KDP, we see around a 15 to 20% margin of safety level. In terms of Wall Street and their targets, well, they have an estimated price of $35.55 over the next 12 months, with upside of 22%, so they do believe this to be a very strong buy now. As always though, do let me know your thoughts in the comments below. Is KDP a stock that you're looking to add? Do you see this insider buying as very bullish? Or maybe this has been one on your watch list and you are waiting for a particular price? As always though, do let me know your thoughts in the comments. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.